Good morning, everybody. Welcome back to another pre-market live stream here. I hope you are having a good morning or wherever you are, evening. Definitely a lot of things to get underway. Let's jump straight into it. I really want to jump straight into it today. I hope that these live streams are helping you guys out. Truly appreciate you guys showing up and just smashing the like button whenever you can, or just supporting me. I truly do appreciate you guys coming out here and taking your time out. So let's get straight into it. On the macro standpoint, honestly, we don't have a lot that has changed. Let's talk about the Fed for a minute, though, since that is the topic of this live stream. Because it does seem like the market's getting very exuberant in terms of expecting a Fed pivot here. And then on the back of Canadian central banking policy, which was just a day ago, they also kind of backtracked their monetary policy by going for a 50 basis point rate hike instead of 75. Now, is that the possibility, for the U.S. market? And truly, what is the Fed going to be waiting for them to really ease monetary policy? And to me, it boils down to two things. Because honestly, excuse me, I don't think it boils down to inflation. Inflation is not going to be the main factor here, because I think the Fed knows by now that inflation is going to be sticky. Okay. What is the main factor here? I think that what is a good indicator of a strong economy would be the unemployment rate, right? Unemployment rate. And I believe that the Fed has already mentioned or mandated that they want to cut monetary policy down or slow it down when we achieve 5.5% unemployment rate. We are quite far away from that, hovering around 3 point something percent. And I think that's one of the main things that they have to really focus on. It's getting the economy back on track, people back to work. Wages kind of pulling up, and that will solve the inflation problem over time. The other problem that they have is credit market risk. And you can see the credit market has fallen off a cliff here, but this is more of a correction back from where we were many years back. So you can see the bond market has been, a very favored market in the past, let's say, 20 years. And all of a sudden, between the year 2021 year 2022, we've had a big explosion of bonds selling off and yields climbing to pretty high levels. Now, not talking like the 10-year yield is at an all-time high or something like that, because it isn't. And if you look at the 10-year yield, obviously in 82 it's gone up all the way to like 16%, something wild like that. But if you look from 2003, we are pretty close to where we were back in 2003 or 04, around that level, right? 4.74, and then in 2007-8, we had once again the financial crisis. So looking at the yields where we are coming back to, it's pretty much a normal level, kind of back to mean reversion here. So why am I mentioning this? Mainly because I've mentioned about the bond market many times before. Remember that credit is a very important significance in the stock market. When credit is very abundant and available, then people are more likely to take on loans. And one of the ways that the Federal Reserve controls money supply is by buying and selling treasuries. So there is a direct link on how treasuries affect even equity valuations, because of just a variety of different factors. Play into that, you have the dollar, which plays into that factor as well. And the dollar has come back to 2000 level highs. The next step for it, if it doesn't pull back here and consolidate for a little bit, which by the way, it's doing the same thing that it did in the past, before moving higher and then coming down, moving higher and coming down, which was the 2000 era .com bubble between 2000 and 2002. we're seeing very, very similar looking price action from the dollar. You can see, it's going to likely come up here and then just chop around this part, which is what happened in 2003. Okay. Now, I'm not saying that that's necessarily what's going to happen, but it does look a lot like it. And so when these things tend to happen, history tends to repeat itself. So all of this plays into one another. First of all, the bond market plays into the dollar. The dollar plays into fiscal policy, and it pulls into monetary policy, right? Remember that the Federal Reserve also has to defend the U.S. dollar, so it ends up using a lot of its reserves as well. Okay, its main mandate is to also lower unemployment, make sure that unemployment is low, and inflation is low. It can't do simply all of these things without breaking something. Meanwhile, equities have a mind of their own, and they're projecting things elsewhere, right? So you have to look at what bond markets are doing first to understand where equities will be in the near future. And from my view, it certainly looks like the Fed intervention is going to happen at some point when they are going to buy up bonds. And there is already chatter about this, by the way, that the Fed is thinking about a bond buyback program. So another thing is, you got to remember that the Fed is almost like a business on its own, and the money that it's going to return to shareholders is pretty much like they can also orchestrate buybacks, right? Remember, the Fed operates literally like a business. They have a balance sheet, right? They take on debt and then they pass the debt on, or sometimes they don't take on debt. And the only thing is that they can print an infinite amount of money to secure that debt, right? So that's a really, really important segment of why you need to understand how liquidity pulls into this. Because the Fed, by buying, if they do really orchestrate that buyback program, then that creates the reverse of QT, which is QE once again, right? So remember, just a brief recap, when you have QT, what does the Fed have to do? They have to take in treasuries, okay? And they have to buy treasuries, sorry, wait, hold on. Am I getting this the other way around? Let me make sure that I'm getting it the right way. Yes, they take in, no, they sell treasuries. Sorry, my bad. QE was this way. QE is when they're taking in treasuries, right? They take in treasuries. So it's easy to get this mixed up because it can be very confusing. So with quantitative easing, they buy treasuries and put out dollars, right? Okay. With quantitative tightening, then they are taking in treasuries, taking in dollars. See, I even when I'm writing it out, I can get it wrong. They take in dollars and they sell treasuries. Okay. So here, this is what they've been doing, right, for a while now. They've been doing this for a while. It's been happening for the past couple of months. And by the way, they have like a blackout period, I believe, this month. And then the end of this month, I think they decide again if they're going to continue on with this. And I think that's where they're talking about, going the reverse route here by buying back some of the bonds. And if they're going to buy back some of the bonds, then they're going to be injecting some cash flow so that, the credit markets can be a little more supported here, because it looks like we're just going down in a dumpster fire. And obviously the Fed knows this. They're keeping track of it. It's approaching a key pivot level. Obviously imagine if the yields on a 20+ year bond ETF, starts to climb upwards of 5-6%. That's quite ridiculous. That's unstable for the bond market, and a lot of people will overcrowd treasuries. So the bond market is starting to perceive this as a slight bullish sign, and that's why you need to understand this. Okay, this is a very, very important part. Now, there's a difference between the Fed slowing down monetary policy through the federal funds rate and quantitative easing and quantitative tightening. There are two different mechanics altogether of the stock market, okay? Or how it affects the stock market. Remember that when we talk about federal funds rate, that is the interbank lending rate between what banks borrow from one another. That's what we call the federal funds rate, okay? So the rate that you see the Fed control, they set a target. Usually it's like 0.25 to 0.5 or something. Now it's already up to, I think 0.4 or 0.5, something like that, right? There's always a range, right? That is the range of interest that interbanks have to borrow again from one another. They don't directly affect that rate. Remember that, okay? They change the rate at which banks borrow from one another. It's a offset. It's not a direct approach. However, when you combine this tool and they at the same time they're purchasing treasuries or selling treasuries, right? If they purchase treasuries, then they're going to put cash out. If they're selling treasuries, then they're going to put cash into the system, right? Sorry, treasuries into the system and then take cash in, which is what they're doing now. That affects in two separate ways. So don't mix these two things up. Okay, that's a very, very common mistake that people make. One affects the market directly, one doesn't. Now, as I said, I think the more important thing that we are going to be looking at in the next few weeks is the stance on the Fed's effect on unemployment rates. I think that will become a more apparent gauge because inflation is bound to be sticky. Okay. So now let's look at the technicals real quick because I spent a lot of time on this and I'm really sorry if I took up too much time. But really quickly for all of you that are here and listening, did you understand what I said? Is there any questions so far? Because I would really appreciate some feedback here. If you understood what I'm talking about. Okay, upward and onward. Looking at the VIX here. The VIX looks hard set to come down to 23.89. That would send NASDAQ and SPY up. The VIX could also midway have a bounce. 25 or 26 here is a pretty strong level for a bounce. And then after a bounce, continue its downward trajectory. So there is possibility for both scenarios. Either the VIX comes all the way down here straight or bounce at 26 and then come back down again after that. Dollar index seems to be taking a pause here, as I mentioned already. Even the 10-year yield looking like it's taking a pause on the daily. Okay. Now, the elephant in the room, or the most important thing that I'm looking at, are two charts, and you'll realize the difference immediately. Check out where SPX is compared to where NASDAQ is. Right? NASDAQ is already almost close to where it was in after the CPI data last month. Right? SPX hasn't even broken its pivot yet. It's still hanging around the 37.61, above 37.61, and still looks super bullish from here. Despite PCE numbers coming in today, which were, they were not better, like not super better than expected, but they were just mediocre, right? They were as expected. A lot of optimism is being built into the S&P 500 right now. This after a lot of mega caps just suffering a blow. Now, a lot of you must be scratching your heads wondering why the hell the S&P 500 is not selling off along with the NASDAQ. Well, that's because of a few reasons. Number one, majority of the earnings that you saw were being priced in, and money had already in advance moved to other sectors. Number two, remember that where the S&P 500 is, there's a bigger effect on this situation on NASDAQ than SPX because the effect of monetary policy being tightened or loosened affects tech stocks more. Okay. So for those two reasons, it looks more likely that that SPX goes further higher to touch. Let's say around 3,900 or so, right? Which we spoke about before. However, that is only if we can break and hold above this 3800, 3820 or so pivot, okay? And we need to break and hold above it, and then obviously the NASDAQ is going to come back from that as well eventually, okay? So that's important thing to note here. And yeah, that's all I have for you guys. Going through individual stocks right now, I like Airbnb for this little pattern that it's in. I'm waiting to play the pivot once it gets to either side. As I posted in my newsletter, please watch out for NVIDIA or semiconductors as a whole. These could really take off, you know, if you get that momentum from them. NVIDIA, you know, could go retest 136 easily. Pfizer is another one. Healthcare stocks have been on the move after a huge downtrend. Pfizer for the bounce here looks nice, you know, to play it up into 48 perhaps. If it can break out of 46, 78. D-Dog for a bearish play. This one is a bearish play. Broken below a long-standing support. First target's going to be around 74.50. Next target 62. And then third target 50 if it really gets nasty. Energy is still a very strong secular sector. So XOM resuming its climb all the way to 112.70 before it sees a rejection. So keep your eyes out on that. Caterpillar, we spoke about this on, I believe, Monday. Nice breakout, earnings hit, and you know, it catapulted up. So yeah, those are the few that you should be watching on your radar. I like the setups. Of course, there are a lot more, but I hope that helps. Make sure you leave a subscribe and a like if you like the content, and we'll see you back on Monday. Peace out, guys, and thanks for attending.